Hello, everyone, and welcome to today's webinar with NewFi Wholesale. We're so excited to have you here. This webinar today is called the Game Changer, and it's all about stackable income. This webinar will be recorded, and after the conclusion of this call, you will get an email with not only the recording, but a copy of the presentation and all of the white label resources we have for you, including a full guide to non-QM loans. Thank you so much for joining us here today. If you have any questions, we want this to be an open conversation. There is a Q&A section, and you can type your questions in there. We will make sure every single question is answered. If not on this call and live with you today, we will get you an answer after the call from your account executive. So we're so excited to have you here, and I would love to introduce our host, starting with Josh. You want to introduce yourself?
Hey everyone, I'm Joshua Jensen. I'm a regional account executive. I cover Colorado, parts of Oregon, and parts of Minnesota. I'm excited and happy to be here.
And Shane?
Yeah, and my name's Shane Nilsson. I'm the West Regional Sales Manager. I get to work alongside Josh, as well as a bunch of other phenomenal account reps in your markets where you sit. And we're really excited to bring this webinar to you guys today. All right, so I'm gonna lead it off a little bit, give you guys a little bit of a history lesson, so to speak, and tell you a little bit about who we are and what makes NewFi your go-to non-QM lender specifically. There in the top left, you're gonna see some bullet points, always around price. You'll always find us, really well situated when you're running Sifter or LoanX or LenderPrice, or even on the Arrive platform if you're on the Arrive platform pricing loans. But the other big things are we are incredibly nimble, innovative, have a lot of resources to be able to come up with options on non-QM, ways to get your borrowers qualified, and we give you a full range of programs in the non-QM jumbo first lien AUS space, as well as some second lien options. And then we believe we've got phenomenal service. We just have incredible people that are here to support you guys every step of the way in terms of getting that loan done all the way from A to Z and taking care of your borrowers. We've got a couple different channels. We've got wholesale and correspondent, depending on where you sit, what you're doing, et cetera. But another really, really big piece in regards to who we are is we're backed by Apollo. Apollo is one of the top private equity firms in the planet, and they have an insurance wing, which is Athene, which has almost an insatiable appetite for these types of products to be able to keep funding these loans, buying these loans, and providing an enormous amount of liquidity at any time in regards to any particular market that we might find ourselves in, to be able to keep doing these loans and providing these programs and products for you guys and your borrowers. So there's a lot of options here, a lot of history, a lot of experience, a lot of knowledge that comes into to partnering with us here at NewFi.
All right, everyone, what does it mean to stack income, and when does it make sense? Here at NewFi, we stack a lot of income types. We will stack full doc income, we will stack 1099s, CPA P&L, CPA gross receipts, asset depletion, asset utilization. We're able to mix and match. And as Shane was saying, we're very nimble when it comes to income. Make sure before you say a final no to your borrowers that you're reaching out to your account executives, because we love the tough situations. Chances are we've done one, we've been through it, we know the pathway for you to go down.
Yeah, I mean, it's a phenomenal option for your borrowers. So maybe you've gone down a route and you've gotten stuck on a regular full doc QM loan, and you're like, gosh, there's got to be a way. There's got to be another asset that they've got. There's got to be another source that they've got access to in some variety. And so that's what we're doing with Stackable Income. We're using all different types of income doc types, full doc, alt doc, asset docs, you name it, to be able to get that borrower inside of the DTI limitations or requirements for whatever that program is or option is that you're trying to get done. So Josh is going to tell us about one of our favorite. It's a new one. So.
All right, this is my favorite. This is how we save loans over here. Stacking with an IRA distribution. Back in the day, people used to use Fannie for the IRA distribution. Well, we've brought it back. We'll stack this with full doc, bank statement, income, 1099. If you're using it alone, it's going to be considered 1 year full doc. If you have another income type where you're providing 2 years of history, we're going to give you 2-year full doc, if you're using full doc, that is. Otherwise, you're going to be looking at bank statement or whatever type of alternative income source that you're using. On this one, there's no distribution required. So how does it read on the statement? Does it say that there's 800,000? Then we're going to use 800,000 if they're above 59 and a half. If they're below 59 and a half, we're going to give it a haircut of 10%. So you're going to be able to use 90% of it. As soon as you get that number, all you got to do is divide by 36, and that can be either your standalone income or your ancillary income.
So wait, Josh. You just said there's no distribution required?
None whatsoever.
What does that mean?
Get out of here.
What does that mean?
You don't have to set anything up. That's such a plus for your borrower. You know, a lot of the times your borrowers are not going to want to go through the hassle of doing that. You know, it is a hassle to set it up. They're going to get pushback from their CPA. Maybe they're going to get pushback from their financial planner. With this, we're literally just going to read off the paper. You know, we're going to verify that it's actually the piece of paper that it says it is.
So what about showing receipt?
No, there's no receipt shown. It literally just off of that number, that piece of paper, it's that easy. Easy peasy lemon squeezy. Yeah. And with this, no tax returns are required unless you're stacking it with full doc income. So, you know, I mean, it gets no better. You're going to get the best pricing here using the full docs. And then also, it's got to be one statement that just covers 90 days. You know, so we're not going to ask you for 12 months of statements. We're not going to ask you for 2 years. You can use multiple accounts too. It doesn't have to be just one with 100,000 in it. It could be the one with 28,000. There's no minimum. There's no maximum. You know, so it could be $1 million one, but you also need to use a $14,000 one. It doesn't matter. So it can be used below the retirement age. And once again, that retirement age that we define is 59 and a half.
So wait, you could have like a 25-year-old kid that's got an IRA of some variety.
Absolutely.
Doesn't have to.
No, it's easy peasy lemon squeezy.
I mean, we have someone in the chat saying they still don't believe it. So
that's okay. We're gonna prove it to you. So quite literally, you can be any age borrower. You could have inherited an IRA from your grandparents or parents or whatever it might be. You don't have to be employed. You don't have to set up the distribution. You don't have to start taking the distribution. You don't have to prove it's been deposited to your bank account. And I know this flies in the face of what everybody's used to when it comes to this type of income utilization. We're here to assure you this is 100% the case. In fact, when we get a little bit later down the line in terms of this deck presentation, Josh is going to show you a real live example of a loan that he just closed. But better than that, if you reach out to your account executive, wherever you sit in the country, almost every one of them has probably experienced that already and can show you a real life example about how that's been done. So believe it or not, it's absolutely true. It's not, oh wait, we can't, this is too good to be. It's one of those situations. It's genuine. This is a real income channel that you can use today. You might, and like Josh said, you might have somebody that's got 15 grand or 20 grand or whatever it might be, and you're at 50 point whatever DTI, and you need to just drop them under.
You just need $200.
Yep, you just need to drop them underneath that threshold to qualify. We'll use it, and you'll get done. You'll be able to take care of your borrower, get them into what they're looking for. So
awesome. We've got some questions around, I think, what's on this next slide. So let's talk about that.
Okay. All right, how does it work? You're once again going to obtain an account statement that's going to cover 90 days or 3 months. You're going to verify it's a qualifying account. Sometimes you'll see different kind of accounts. You'll see a traditional, you'll see an inherited, you'll see a custodial one. You just want to make sure it's theirs. And how do you do that? You send the document to your account executive. If they can't figure it out, we have a full-fledged scenario desk. If not, we can go to the head of credit. I mean, here at NewFi, we have multiple people all with their ears open. They're looking at these types of things all day long. So we can get you an answer very quickly. And once again, are they under 59 and a half? Take the balance, multiply by 90%. So that's a 10% haircut. If they're over 59 and a half, no discount needed. And then you just divide by 36. That'll give you your monthly income.
And I think the next slide is actually
yeah, it'll give a breakdown.
It's a breakdown in terms of how it works.
Okay, so we have a borrower's age 47, 2 years older than me, has a Roth IRA with an $800,000 balance. You'll take that balance, multiply it by 90%. That will give you 720,000. Then you divide by 36. That gives you a $20,000 monthly income. We know that, once again, we know that not everyone has 800,000. And so even if it's 40,000, even if it's 100,000, we're always going to want to see it. Your first question should be, when they say, like, I have a lot of money in accounts, just say, is it an IRA? Okay, can you get me the statement? Make sure the statement covers 90 days. It's literally that simple.
That's right.
For this one, we have a borrower who is 60 years old. He has a SEP IRA with a $200,000 balance, and he also has a traditional IRA with a $100,000 balance. So we're going to have a total of 300,000. They're 60 years old, so there's not going to be a haircut. You divide that by 36. That will give you $8,333. And once again, you can use this on its own.
But this example actually has where they've got a part-time job, so
right.
you can add it to it. They could have a full-time job. I don't know. Maybe you've got a guy that's retired and he's decided he wants to go take a part-time job at Home Depot, and he wants to direct traffic or sell tools or whatever it might be, and he's making, I don't know, 20, 25 bucks an hour. Add this to it to take care of him for whatever his transaction is you're trying to take care of for him.
One thing I want to touch on: this can be a 401k. You can use this, but only if it's abandoned. And when I say abandoned, I mean they do not work for that employer. So an IRA distribution is typically an IRA account, but they have a 401k from an employer they no longer work with. This calculation works as well.
Yeah, that's right. If it's an active employer 401k, those have different requirements in terms of what you can do in terms of setting up withdrawals, etc. So those particular ones can't be used. But again, like Josh said, if it's an old 401 that they've moved on from and haven't converted or whatever else, and you can show that that's the case, we'll use it for this process.
We have a bunch of questions. You guys
All
ready?
right, let's go.
Does this qualify under asset? It says dissipation, but I think there might be like utilization.
No, it's not an asset depletion. It's not an asset utilization. It's literally turning an IRA into income. And well, we're doing it in the traditional method that you would have been used to, except for we're not requiring the same level of documentation that you would on an agency deal, and we're also not restricting age in terms of whether or not you can utilize it. So no, it's not. Although the calculation is over 36 months, so it makes it feel a little bit like that. But we're calling.
We just want to see a 3-year continuous.
Yeah, absolutely.
Yeah.
Can borrowers use non-occupied parents' IRA assets?
So any borrower on the transaction that's contributing. So if you've got what they mean is, or what the question is, I assume is it's a non-occupant co-borrower, and that's the income that they want to use for the non-occupant. Yes.
What is this program called when pricing rates? I have a conventional guy that went 1099 last year, but he's looking to lower his rate.
Yep. So this is going to be on one of our non-QM lines. So you're looking at Sequoia Expanded, or Rainier.
Rainier is going to be capped at 80% LTV, and you're going to want to make sure that your DTI is not over 45.
Right. So there are some different, and we're going to get into some of those differences in terms of some of these program options a little bit later in the deck, but it's going to either be Rainier or a Sequoia derivative.
What if it's assets, not retirement?
No.
We can use those, but that's going to be in the traditional asset depletion category. Different calculation. Usable assets post-close divided by 60 months.
Can this be used with cash out loans? Usually asset depletion cannot.
Yeah, it's not asset depletion, so it's a distribution. Yep.
But it also can be used on second homes. It can be used on non-owner and on primaries.
Yeah, any occupancy type, any transaction type on that level.
Great. That was the next question.
What else you got?
Let's keep going. I think we've got some questions that will be answered on these slides.
Okay.
Okay, so there's multiple different IRAs, and always, like I just said before, it's always best to just forward the statement to your account executive. And once again, if he doesn't know, or she doesn't know, or they don't know, they can forward it to the scenario desk. They can ask me, they can ask Shane, they can ask one of our managers. One way or another, we'll get you an answer really quickly. So what type of IRA is it? Is it a Roth? Is it a traditional? Is it a SEP? Is it a simple? Or is it a rollover, inherited, custodial? If you want to flip to the next slide, I kind of have some verbiage on that one. Once again, is it theirs? It has to be theirs. It needs to be theirs. Sometimes you'll see a custodial IRA, which we would need to prove it's theirs. Sometimes it's an inherited account, which we would want to see additional information to verify the terms. Make sure you're sending the. I can't reiterate this enough. Just send it over, and then we'll get some more questions out to you to verify exactly what we're looking for and if it is usable.
Exactly. Do you have any other questions that we didn't address there, Keela? Or
Yes. Is IRA distribution combined with pay stubs considered a full doc loan?
Yes.
Do you need a letter and receipt of the first month?
So let me go back to that first one. IRA distributions on their own are considered full doc. So when you pair it with regular full doc, it stays full doc. The only time that you would deviate into an alt doc is if you're pairing it with 1099 or bank statements or something along those lines. Then it's gonna follow the most aggressive, so to speak, doc type in terms of that. Sorry, your other question was?
Can this be used for a primary residence?
All occupancy types, primary, second home, non-owner, any of them.
Is it allowed on a Texas cash out?
Yeah.
Awesome. And when stacking the IRA with full doc, if you're doing a W-2 borrower, do you still need tax returns?
No, W-2s only.
Great. All right, let's keep it going.
All right, so
CPA and financial planners love this. Reach out to your account executives. We're really well versed in presenting these. I personally have done some with financial planners on the line. I've done them with CPAs on the line. Why they don't is they don't have to set up the distribution. You know how back a couple slides ago I said the borrower doesn't want to do this because it could be a huge pain to do this. Well, the CPA and the financial planner, they don't want to do it either. If you're taking money out of these accounts, you could be reducing their paychecks. And so by just going off this balance, you're keeping it so easy and so simple. And also there's no tax ramifications. And once again, it can be used for investment properties, seconds, and owners. And less work means more referrals. Do you think one of these CPAs or financial planners, if Jimmy comes around and he said, oh my God, I went through this non-owner, I had to provide tax returns, I had to provide business tax returns, I had to provide just like the kitchen sink and my firstborn. And you know what? When we make it simple, we get referrals. And this is a plus, you know, because time is money. We expedite these quickly. We can speed up the process, and with less documentation, it always means more referrals.
absolutely.
Sorry, I skipped a question. Can we go back to, do you need a receipt of the first month IRA distribution to use?
No.
Okay. And do you have information on the highest DTI?
45 on Rainier, 50 on Sequoia.
And the max LTV?
90.
High fives.
What is your reserve requirement?
So it depends on two things. One could be the LTV, and the other is loan amount driven. So if you've got a transaction that's up to 750,000 and the LTV is up to 85, you've got a 3-month reserve requirement. When you peak above 85% to 90, it goes to 6. But then you also have some other loan size adjusters in there. So when you get above 1.5, 750 to 1.5 is 6, above 1.5 goes to 9, and then when you get higher
12,
to
15.
Yeah, the higher the loan amount, you could have a higher
Reserve requirement.
Yep. But again, reach out to your account rep. They're going to take care of that particular question on any of your transactions that you might have, and oftentimes find a way to help you get it under into a lower threshold so that you're not having that heavy of a requirement. So,
Is there a minimum credit score?
620.
620 on expanded, right?
And can the IRA we're using be used as reserves?
You don't have to use the full amount.
Right.
So yeah, you could, if you had $1 million and you only needed to use 500,000, you could keep that other 500,000 back for reserves.
Yeah.
Any amount that you're not using in the income calculation, you can use for reserves.
Yeah, there's a way to be able to balance it in terms of what's needed.
What if the borrower has already started their distributions? How do you adjust the calculation?
We're still going to take the balance off of it because we're not requiring receipt or otherwise.
Do you have prepayment penalties on these programs?
Only on non-owner occupied options.
And that would be if you want to put one on.
It's an optional piece in regards to non-owner properties. You don't have to have a prepay, but on primaries and second homes, there are no prepays allowed. No.
On a primary purchase, do you allow a gift of equity from a related seller?
Like a parent or a family member or something like that. Yeah. So gift of equity just follows normal gift guidelines.
Awesome. Let's keep going.
All right. So we talked a little bit about you can stack this income type with anything. So you can stack it with one of our CPA options, a P&L or a gross receipt. So you're going to use it on one of these guys when perhaps the P&L doesn't quite make it, but P&L loans and gross receipt loans, typically, it's reduced documentation. You're going to get the P&L or the gross receipt letter from the CPA, then you're going to validate that the income stream is continuing with a couple of months worth of bank statements, and it works essentially the same. You're going to take either a 50% expense ratio off of the gross receipts, or a P&L, we're just going to take it right off the bottom line. So according to whatever your ownership structure is that you're trying to, or your borrower has, that's where we're going to take that number from. So if it's, the P&L comes out at 100,000 net and they've got 50%, then they'll get just over $4,000 a month. But again, you will get some depending on the overall doc type that we're stacking with, you are going to have different LTV requirements. Any of the CPA products require, or the max is at an 80% LTV. So, yep. So that's one. Next slide.
Can you take a question real quick?
Yeah. Fire away.
What are your current turn times?
2 days.
Yeah, initial underwrite, about 2 days. We're closing non-QM loans, soup to nuts, in about 22, 23 days.
And are you accepting crypto funds?
So crypto is an emerging asset type, and there are some types that can be utilized. It's probably a better question to dive deeper on a one-on-one basis, but typically speaking, you could, once they're liquidated, you can use them. Not necessarily, you're not going to, although I think there is potentially one firm out there that offers an IRA type of an account with crypto, but that's not as mainstream as some of the other options. If you've got crypto funds, typically it's cash to close. You're going to liquidate it into fiat currency and then transfer it to your regular bank account. But that's probably a deeper dive conversation.
Is your loan cap 3 million?
No. And when we get into one of the later slides, you'll actually see that we have an option to go all the way up to 5 million on regular guidelines. And then in certain cases, we can get exceptions to go above 5 million.
Great. And is your expense ratio always 50%?
No. On all doc type loans, that's the
standard.
That's the default. If you don't want to dive into any more documentation, if the 50% works, then great. No reason to drag your borrower through anything or have them get their CPA involved. But if you need a lesser expense ratio and it makes sense for the business type that they're in, then absolutely their CPA can confirm what that expense ratio actually is.
Awesome. Keep going on to 1099.
All right, Josh.
So you can stack these with 1099s. We all know people, they're gig workers. Gig workers are such an emerging market. When I say gig workers, I'm talking about Uber, Lyft, anyone going to grab your groceries. We all have tons of apps on these phones that we're ordering something. So people are starting to make more and more money on it. For this, we could do 1 to 2 years of 1099s plus year-to-date proof of income. The expense factor is going to be a 10% flat. Otherwise, you could get a CPA attestation letter to go as low as 5%. So your formula is going to be your gross of your 1099 minus the expense factor divided by 12. So if you have 120,000 in 1099s, you would minus it by 10%. That give you 108,000. You divide by 12, that would give you $9,000. The rules are you must be 20% owner in this, and the max LTV is going to be 80%. You're going to verify the activity, which means the deposits, with most recent 4 months bank statements, and that number that you're using for income from that $108,000 qualification or the $9,000 must be within 85% of the qualifying income.
Excellent. Any questions there, Kayla, or do you want to?
Yes. Are non-permanent residents allowed?
So they would be here on some sort of an EAD work permit basis, then yes.
Great.
All right. So this is the example that we referred to. It was a live loan. I think it closed last month. Absolutely. Josh is going to take you through it.
So I had a loan officer. He called me. Oh my God, I can't believe this is happening. They said they could do this. They said they could do this. And then they got the income. And when I say they, I mean an A prime lender. Oh my God, we can do this. We can do this. No, they couldn't do it. So he called me and said, Josh, is there any way you can save this? And I said, okay, number one question, do they have an IRA? And he said, yeah, actually, they have $1 million in an IRA. And I said, well, we're going to lower your DTI by quite a bit. So this one was an 85%. Actually, it started with the other lender at 80% because that was their guidelines to go up to. We got it all the way up to 85% LTV. So they brought in less money. And because we were stacking the IRA with a W-2 job and we had 2 years, we used 2-year full doc pricing. Their back-end DTI was 48%. We closed it in 21 days with a transferred appraisal. So I looked like a hero. He looked like a hero to his borrower. And, everyone walked away happy. This is one of these scenarios where you always just have to say, I know I keep saying this, but whenever they say I have $1 million, I have a ton of assets, say, is any of this an IRA? This has literally it's increased my pipeline. It's increased all my loan officers' pipelines. I have people calling me because they've been referred by another loan officer. So this is going to give you a really sharp tool in your mortgage toolbox. And if you're not using it, Johnny down the block is definitely using it. He's heard of it. He's going to use it. So do yourself a favor. Familiarize yourself with this. Place a call to your AE. Call them right after this and say, hey, I need to learn more. I have this situation. I have that situation. Say, can I do a presentation to CPAs? Can I do, if you're a mortgage broker, can you do a presentation to my loan officers? Everyone needs to understand this because we need to stop saying no.
Absolutely.
Don't say no. If they have an IRA, make sure you're running this scenario through us.
And Josh, on that scenario, were you comparable on rate?
On rate, yeah, we were extremely comparable. I believe we were like 1/8 of rate less.
Wow.
Yeah, or no, excuse me, more. Yeah, but that could be because we went to 85% LTV and the other loan was at 80% LTV. So if we're comparing apples to apples, then I would say we're probably better if they would have kept it at 80%.
And do you know today's about current rates on these programs?
I don't think we actually have a pricing scenario in terms of what the presentation on the deck is here today. But if you've got some parameters you want to vet, you want to check out where we sit, absolutely call, email, text, whatever it is, your account rep, wherever you sit locally. Or you can reach out to either Josh or myself. Running pricing is pretty quick. If you have access to our portal in blue, you can also run a price and see where it sits in regards to that as well.
Awesome. Okay, we've
Again,
got
I'm going to go back to one of the very first slides. We're always going to be competitive in this region. And the bigger thing to bear in mind here is everybody always talks about rate. Everybody wants to know what their rate is. Sometimes rate's not the most important thing. Sometimes getting the loan closed is the most important thing. And it might be a small sacrifice in payment or rate amount that you're giving up in terms of getting the loan closed, but it means the difference between that transaction closing or not, and that borrower getting into the home that they're looking for or not. So it's bigger than just a rate question, but we're always going to be super competitive. Yes.
And can you remind them of the names of these products for pricing in blue?
Yep. So Rainier is going to be your better one. Then you're going to have Sequoia and Sequoia and Expanded, depending on where you sit credit wise.
And LTV.
And LTV
And
wise,
DTI.
correct, correct. Yep.
If you're stacking income, do you get a hit on the pricing?
No.
Mm-mm.
Great.
You have to take the pricing, say if you're stacking bank statements with an IRA, you have to take the bank statement pricing.
Price, correct.
Great. Can you stack all of the above, W-2, IRA, and asset depletion?
Mhm. It's all day, every day.
We will stack any and all that fit the mold. So maybe you've got a spouse you've got the borrower one that owns a business and they're going bank statement. You've got their spouse that's a W-2 employee in whatever capacity. And then you've got asset depletion. They've got a bunch of cash that's not in an IRA, and then they've got an IRA. Absolutely. We'll stack any and all.
Awesome. On the program, you cannot do this with DSCR, correct? We've got some questions.
No, DSCR is a completely different category, correct?
Are PERAs okay?
PERAs. I'm not familiar with
I don't either.
PERA. That's probably something that, like Josh said,
Pension or something?
you might want to get a copy of the statement and send over to your rep to vet.
Can you use a self-directed IRA?
There are some caveats. So it depends on how that self-directed piece is set up. Probably, again, another situation where you want to vet that with your rep.
You want to see what it's invested in. For instance, if it was invested in an LLC that they own, then that would be a no.
Yeah. It depends on the setup. So people have self-directed IRAs and they own properties, self-directed IRAs and they own businesses. Those are, again, going to come down to how it's
contact your AE.
Yeah.
If you don't need to disperse assets towards the mortgage payment, then how does it work?
I'm not sure I entirely understand that question, but I'm going to take a stab. So I'm going to go back to, we don't require a distribution setup on this whatsoever. You don't have to prove receipt of those funds whatsoever. We're basically going to take whatever that usable amount is and divide it by 36 months. And that's the amount of income that you're going to get for that transaction.
Does any of this work for a closed-end second?
No. So it doesn't work on our closed-end second product.
Do you offer this for ITIN borrowers?
We don't have ITIN.
We don't have ITIN, correct.
Got it. And then can we go over, we have several questions on the reserve requirements again and the calculation. I'll go back to that slide.
All right, so if they're under 59.5, you're gonna take 90% of the balance and then divide by 36. If they're over 59.5, you'll take 100% of the balance and divide by 36.
Awesome. And what are those reserve requirements?
Again, it's going to depend on LTV and or loan amount. So up to $750,000 and 85% or less on the LTV is 3 months. Above 85%, it's going to go to 6 months. Above 750 to 1.5, it's 6 months. Above 1.5 to, is it 2 million? I think it is. That's 9. And then it's going to go up from there.
12, 15. It's usually in like $1 million or $500,000 increments.
Yep.
I got this email today. No minimum time as a 1099 employee, borrowers who switch from W-2 to 1099. Can you talk about this?
Yeah, absolutely. So that's another one of the programs that we've come out recently as well. So you've got borrowers that have been in the space. In fact, Josh and I were talking about one not very long ago where the borrower is a doctor and he had been W-2 at one hospital and he's migrated to a new hospital, but they're paying him on a 1099 basis. He has no expenses. So we're going to use the new 1099 contract amount at full whack. No 1099, you don't need to get into all that detail. You're going to get a copy of the contract or get a WVOE, and all the employer needs to do is confirm that there's no expenses. So it's really popular in the legal space and professional space like lawyers, accountants, doctors.
They can't have employees.
Yeah, no, they can't have employees. They can't have a brick and mortar type shop or anything along those lines. So, but it's really popular in a number of different growing industries and the tech space.
And we have some of my favorite questions. Do you have marketing material on this? And how long until I can get a flyer? Well, you don't have to wait long here. Uh, we have, and we'll go there, but we have a bunch of customizable marketing for you. These are two. We have one specifically on the IRA, and then all the different types that you can stack together on ways to qualify without tax returns. Those are available for you and will be included in your email that gets sent out at the end of this call.
Yeah, that's right. White label marketing. We've got Kayla and her team have done a phenomenal job of compiling an enormous amount of resources for you guys to be outbound and in front of your agents, your previous clients, your CPA, attorney, you name it. She's got social media posts that you can localize to yourself. White label flyers. We've even got like a second lien playbook where it gives you like a 30-day by day session, what you need to do to go in and drive some of that business your way. So yeah, there's an enormous amount of material and opportunity here for you guys to be able to find these loans.
Awesome. And we'll go back here and talk about some of the final questions we've got. Thank you everyone for your great questions. Okay, so is bank statement or asset depletion income considered alt doc or full doc?
Alt doc.
Awesome.
Yeah, that's in general what renders it a non-QM, right? So it's a non-qualified mortgage because you're not deriving income from traditional W-2 or tax return sources.
I have a buyer buying a primary home. He already has 3 rentals. How does this program deal with the 3 mortgages and his rental income when calculating DTI?
With or without tax returns, I guess would be the question. So you can do it one of 2 ways. So if they don't need to deal with the rental income off of it, and there's enough income from the IRA, then just hit them for the full payment and move on. So there are options there. And again, another great question and probably deserves a deeper dive with your account rep.
And can you stack IRA and P&L statement and W-2?
Yes.
Yes.
I'm going to reiterate any and all income types that we offer you can stack. There's virtually no restriction to how many.
Awesome. What if they are 1099, but they pay out their children for work done, not employees technically?
Yeah, so
if they're still kind of
it's still kind of an employee, so they're using it as some sort of a write-off. I mean, that's probably something you want to get deeper into in terms of a conversation with your rep, determining what that borrower does, where their income stream is. Do they, do they have supplies? I mean, there's any number of things that can come into question. They might fit more in the lines of the regular 10% ratio, 1099, or 10% expense ratio, 1099.
Okay. Let's see, all incomes except DSCR, correct?
Yeah, DSCR is not an income type.
There's no DTI on DSCR.
Yeah, it's DSCR is specifically for investment properties only, and it's all based on the cash flow of the property.
Awesome. And for the W-2 to 1099 program, would that work for loan officers who move from W-2 to 1099? Would you still be able to use the full amount?
So loan officers typically have expenses.
Yeah, how would you have a W-2?
Yeah, realtors typically have expenses and they get 1099s as well. Yeah, it's not a no expenses category.
All right, I think that's it then. If we have not answered your question, we'll make sure we answered every single one and we will get that back to you. Thank you everyone for joining us today. If you are not working with NewFi and you want to get connected to an account executive, reach out in the chat right now. You can type it and I will get you connected, or you can email us at marketing@newfi.com and I will connect you to your AE. At the end of this call, in about 2 hours or so, you'll get an email with this recording, with this presentation, and those awesome marketing materials we talked about in our guide to non-QM loans. Thank you so much for hosting, you guys.
Thanks
Thanks,
again.
everybody.
Appreciate it.
Have a great day.
See ya.
See ya.
Have a wonderful day.